Hello and welcome to our discussion on accounting and our series on the frequently asked questions in accounting. And today's question is relates to the bad debts. What are these bad debts and how is bad debt shown in the financial statements? Bad debt is actually a loss due to the insolvency of the debtor. When you sell goods and the debtors fail to pay, and you write off the debtors because they become insolvent or bankrupt, the amount not recovered from the debtors is called the bad debt. The treatment of the bad debt in income statement, balance sheet and cash flows is as follows. In the income statement it is shown as a loss. Bad debt is shown in the income statement as a loss. In the balance sheet the debtors are reduced to the extent of the bad debt, and in the cash flow no effect due to the bad debt. Maybe that the debtors may pay only to the extent which has not become bad, but the bad debt directly has no effect on the cash flow statement. We'll continue with the simple balance sheet which has some sources and corresponding assets. And we have taken only one transaction, so your collection during the period 90%, no other transaction, and the balance of the debtor has become bad. So the opening cash in hand 100,000, no incomes because collection is not an income but the reduction of the assets, that is the debtors. So we are collecting 90% of the debtors, 0.90, and the balance debtor is bad debt, and bad debt is shown in the balance sheet as a loss in the balance sheet. The debtors minus collection is the bad debt is shown as a loss. Now since no other expense, no other income or profit is minus 15,000, profit is minus 15,000, so because no incomes, so the profit is minus 15,000. The entire bad debt is treated as a loss here, loss, and the debtors will be reduced to the extent of 135 and to the extent of 15,000. So the debtor has become zero. Debtor has become zero because of the collection 90% and the bad debt 15. Bad debt, the balancing figure of the bad debt, so which is 15,000. And in the process we can also see the balance sheet. So the cash in hand is equal to 100 plus 135. So in the balance sheet cash will appear 235. No change in the capital. The reserves will come down to the extent of the loss for the period. No change in the loan, so the balance sheet is done. So the bad debt is in the income statement is shown as an expense, and bad debt is reduced from the debtors in the balance sheet. So bad debt is a loss due to the insolvency. No cash flows, corresponding cash flows for the bad debt, but bad debt is a reduction of debtors. Thank you very much.